This month's question comes from Dave, who owns a small service-based business, and he asks, will I have to pay taxes on the sale of my business? Dave, I'm answering your question in my next 2 episodes, so I hope you catch them both.
Welcome to this episode of Accounting and Tax Tips, Smart Strategies for Small Business Success, with certified public accountant Tina Moe.
That's a great question, Dave, but there are a lot of details to consider when selling a business. So the answer, while most likely is yes, contains many variables that will determine how much tax you'll pay, whether it will be capital gain or ordinary income tax, and when you'll pay the tax. But first, let's begin in this episode with the different types of business assets there are. And let me provide some information about them so you have a very basic understanding of the terminology. There are tangible assets and intangible assets, and they are typically taxed differently when sold. Tangible assets at the most basic level are assets you can touch, while intangible assets you cannot. Examples of tangible assets would be equipment, vehicles, and buildings. And examples of intangible assets include goodwill, customer lists, and trademarks, to name just a few. Within the tangible asset category, you have both personal property and real property. In my prior examples, equipment and vehicles would be considered Section 1245 personal property, and the building would be considered Section 1250 real property. And when I use the term personal property, I don't mean property that you personally own. I'm referring to property other than a building, which is referred to as real property in the tax world. So to recap, equipment, vehicles, and tools are considered personal property, and building structures are considered real property. Hopefully that gives you a little understanding. Intangible property is referred to as Section 197 property, and it refers to assets such as customer lists, trademarks, covenant not to compete, and goodwill, just to name a few. These assets are typically amortized over 15 years, not depreciated, but the basic concept is the same. You're writing these assets off over a period of time set forth by the Internal Revenue Service. So also, please keep in mind that I'm really simplifying the tax code here, but this video is meant to be at a very basic level. Hopefully that gives you some basic information about the different types of business assets you might be selling. Tune in to my next episode when we talk sales structures.
Thank you for watching this episode of Accounting and Tax Tips with Tina Moe. For more great information, visit Tina's website at www.actservices-inc.com. Also browse the other shows found right here at Indie Biz TV Shows.